Corporate finance presentation, government securities. Get ready, it's time to take your chance with corporate finance. U.S. government securities are used to manage the federal government's debt to help with cash flow. So same kind of process with the government as with a for-profit company, meaning if they need cash flow, they need capital, they could issue the securities. They may issue the short-term or long-term securities to help with financing and will retire securities when there is a surplus. In other words, if they have a surplus, the idea being they retire the securities. Now, typically, the government may be a little slow to do that. It seems like they are always needing more money, but that's the theory of it. Then we also have credit agencies that are federally sponsored. These are government units that issue securities on a separate basis from the ones sold by the U.S. Treasury. They includes the Federal Home Loan Banks, or the FHLB. We have the Federal National Mortgage Association, Fannie Mae, the Federal Home Loan Mortgage Corporation, Freddie Mac, the Student Loan Marketing Association, Sallie Mae, the Farm Credit Banks, the Federal Agricultural Mortgage Corporation, Farmer Mac. Then we also have the state and local securities. So we have a similar situation on the state. Obviously, anytime we think about the government, we need to keep them separate. If we're talking about U.S. government, we have the federal side of things, and then we have the state and local side of things. So state and local securities, municipal securities, or tax-exempt offerings, often purchased by investors who are in high marginal tax brackets. So oftentimes you're looking at the state and local. We have those municipal securities or tax-exempt securities, and that, of course, will be attractive to people that are in the higher tax bracket. So if you have high-income earners, then they're going to be concerned about the fact that the next dollar that they earn is at the higher progressive tax rate, and therefore they're going to be more likely to be looking in at types of investments where the money that they received will be tax exempt. If you're in a low tax bracket and you're paying little taxes, then obviously you're not going to be as concerned with it, given the fact that it's not going to have as much an impact. Higher earners, because of a progressive income tax system, the next tax dollar that they're going to have in will have a higher impact, and therefore that tax exempt status could be useful there.